By the way, I learned something. I thought I had lost this stylus pen, and I said to the people at the computer center, oh, just send up 2 more. They said, no. We're not sending up 2 more. We gave you one, and if you lose it, it's out of your pocket. I figured, okay, just send me the address. I'll get 5. Why not? It's a piece of plastic. Do you know how much these things are?
$200? 200.
No, it's not that bad, because I thought I'd ordered 10, but they're $47 a piece.
Okay.
I'm not getting $500 worth of. I'm not quite sure why it's that expensive. It literally is a pen. I mean, piece of plastic, but maybe I'm missing something. I think it's just a regular stylus, but people have told me that it's more expensive than I think. And that this is. So be forewarned, if you have a stylus, do not lose it. And I'm going to guard this one very carefully. Anyway, guys, let's pick up where we left off. Let's talk about where we are. And, I have to say, I like to say we're making a lot of good progress, so kudos to you for trying to keep pace. It's not easy stuff, so if you feel, oh my God, this is challenging, I am sure I speak for everyone, you're not alone. People do this stuff for years. It does not come easily, it does not come naturally. So if there's any solace in that, is that this is a time-consuming process. It takes a lot of time, effort, and energy. So I warned you that from day one. I think you see it's coming true. All right, so bearing that all in mind and looking at the table of contents, just to remind people of just the larger picture, which I think is always good to remember, that chapter 1 is just an introduction to subchapter K and the choice of business entities. I stand by what I said initially, and I'll stand by it the entire semester, that your time here will be well spent, because by knowing subchapter K of the Internal Revenue Code, it unlocks the door to help your clients, because many of them are going to start off in the direction of being a limited liability company. So know that in advance that this is, in many instances, the right entity. Now, at some point, people will argue maybe they should go in the way of a C corporation, because there's a code section 1202 that ultimately they could perhaps sell their interest and not recognize a gain. But just keep in mind, without getting into the politics of good, bad, or indifferent, next year there'll be an election, and some of these code sections that are written very favorably for corporate America may not be the case a year from now. So I would prophylactically go with something that's time-tested, as opposed to going something that could be a race. No matter who's elected, I think the fundamental tenets of Chapter K will remain intact. And I can't say as much for some of the more favorable corporate provisions. Formation of a partnership. Red carpet treatment, right? Anything goes. Virtually anything goes, right? And you form a partnership, 721 is going to protect it from taxability. And the notion is with 722, 723, a preservation of the embedded gains and losses, right? Code section 722, 723, preservation. The authors do in chapter 2, hopefully when you look back in chapter 2, there'll be some reinforcement, discuss treatment of liabilities, and sometimes taxpayers do shed liabilities in a way that sometimes can give rise to a gain recognition. So you do have to be forewarned that just like the Tufts case, if you shed enough liabilities, depending on your outside basis, can give rise to gain. Why are the authors doing this in chapter 2? Because people, again, make contributions with property subject to liabilities. Organization and syndication expenses, we discussed, code section 709, right? If they qualify as organizational expenses, generally amortizable over 15 years, akin to code sections 248 and code section 195. All right, then we moved on to operations. We got the general rules about property gains and losses are determined typically at the partnership level. partnership basis adjustments under code section 705, that basis can go up, basis can go down. There's fluctuations there. And then we talked about limitations on losses, right? And we saw, and this is somewhat universal, it's not unique to subchapter K, right? This is something you should take outside this classroom, that there are many limitations with losses, right? Losses must be realized, recognized, and allowed. Code section 165 generally opens the door for those allowances. But in the partnership realm, you got to be very careful of 704D, the basis limitation rules. Then you have the at-risk rules at 465, the passive loss rules at 469, and complements of the most recent Tax Act, Code Section 461L, puts the brakes on deductions in excess for single taxpayers, $250, married taxpayers, $500,000. All right? So we got chapter 3 under our belt. Then we moved on to partnership allocations, right? And we said that with respect to partnership allocations, virtually anything goes, right? But George, we said, what do you need? Say it loudly. Substantial economic effect, right? All right, so C, S-E-E, right? Substantial economic effect, that if you have the principles, or meet the principles of maintaining and respecting your capital accounts, right? Maintaining and respecting your capital accounts, and making sure that even if you go negative, that connotes an economic responsibility that you have to pay that deficit. So many instances that test cannot be met, but the partnership agreement, if it has a so-called qualified income offset, where if someone does go negative, who isn't going to be held accountable, that they will quickly have to make up that deficit. That's going to be respected. And we talked about the fact that you can't have shifting or transitory allocations, right? And that's where the word substantial comes in, that you can't have shifting or transitory such that one taxpayer is better off from a tax perspective and no other taxpayer is worse off. So we looked at chapter 4, taxpayers allocations, and again, if you respect those capital accounts and their substantiality, you can allocate generally as you please. Now, that's chapter 4. Used to be, in the earlier editions, chapter 4 and chapter 5 were one chapter. For the authors, I think, to their credit, this is an enhancement to the textbook. Chapter 5 is a new chapter. It's just to emphasize where you might think in chapter 4, carte blanche, that you can do whatever the heck you please. Chapter 5 says, okay, George will tell you, you can't do whatever you please, but you might think, okay, as long as I have substantial economic effect, I can do as I please, right? But then there's even a further pullback in chapter 5. Congress is always worried about income shifting. Why? Because Code Section 1, we have a progressive rate structure, right? And if you can recall from your days of Lucas v. Earl, right, the famous Lucas v. Earl in the assignment of income doctrine, taxpayers are supposed to not be able to assign income to other taxpayers in a way that they can collusively minimize their tax burdens. Everyone agree? Lucas v. Earl, from many, many years ago, the case I believe is soon celebrating its 100th birthday, said you shouldn't be able to income shift. Well, chapter 5 embraces that philosophy and illustrates that with several code sections. In particular, code section 706C, 704C, code section 704C, with respect to contributed property. We went through both the sale of contributed property, where there's embedded gains and embedded losses, right? And we tried for the non-contributing partner or partners, plural, the non-contributing partners, that the whatever happens in their capital account, we try to match with tax, right? We try to match with the tax effect. And whatever's left ends up going to the contributing partner, right? And we have three different methods: the traditional method with curative allocations, and then the so-called remedial method. And with respect to contributed property, we saw what would happen if it's bought or sold. And then secondly, with respect to depreciation of that contributed property, right? Again, with contributed property and depreciation deductions, our philosophy is generally give the non-contributing partner their whatever the appropriate depreciation they had for book purposes. We saw with the so-called remedial method that we actually created two assets, right? Two assets for purposes of that depreciation computation. All right, so that's code section 704C. Then we looked at 704E with respect to partnership interest acquired by gift or purchase of a family member. And Congress, again, tried to be sensitive that family members being part of the same family might lend itself to collusive behavior. And then we saw 706G that if there's different interests, partners have different interests throughout the year, we have to take into account those different interests. And generally, that it's going to be the interim closing the books method, or we could have a pro rata method. Okay, there's two different methods that can be employed with respect to Chapter 5, Part C. Chapter 6. Okay, Chapter 6. We looked at partnership liabilities. And with respect to partnership liabilities, what code section controls here, Alvin? Do you remember? Go to code section here. For partnership liabilities. Or Jacqueline, do you remember? Oh, yeah. Kevin? Viva? 752, right? And Ken, what does 752 say with respect to recourse liabilities?
Share by both.
Okay? Pretend this doomsday scenario, right? Everything becomes worthless. In that instance, who would have to pony up, right? Who would have to pony up if everything became worthless? And that's to whom. And what does this affect? 752, right? Affects what? Nikki, what does it affect? You recall? Not sure? Go ahead. Your outside tax basis, right? Your outside tax basis. Right? Your outside tax basis. Just make sure you get that. Because sometimes, remember when we dealt with substantial economic effect, we were consumed with what? Capital accounts, right? And I said, historically, students don't bifurcate it. One deals with capital accounts, now we're dealing with outside basis, right? And remember, when there's liabilities, do liabilities affect capital accounts? No, right? Because capital accounts reflect your economic stake in the enterprise. And when you have a liability, then some third party has an economic stake on the other side of the ledger sheet, right? All right? So recourse liabilities, we go through this exercise, and we're going to determine each partner's outside basis. Why is that important? It's important, for example, due to the loss limitation rules, right? When we were talking about loss limitations, and you can't take a loss in excess of your outside basis, agreed? That was the first limitation. And remember, those rules go in a tiered order. You first look at the basis, then you look at the at-risk rules, then you look at passive activity, and then the overall loss limitation rule, 461L. So just bear in mind, it's not you just choose which one might apply. There's an ordering. And that's why outside basis is so important, right? When it comes to non-recourse liabilities, non-recourse, Sandra, how are those allocated? Not sure? Huh? Say again? Loss ratio, is that Alan right? Say again?
Profit ratio.
But Michael, you had your hand up? Profits percentages, but we got a little bit more complicated, right? There's actually three different, it's like a 3-layer cake, right? The 3-layer cake, let's just go back because this gets a little, it generally is, right? Generally is with respect to your profits, not your losses, right? Your profits, not your losses. But if you look on page 210 of the textbook, it's the partnership minimum gain. The partnership minimum gain. 2, in case of non-recourse liabilities of contributed property, the amount of gain the partner would recognize under 704C. So it's this, the first one is minimum gain, the second is 704C gain, and then whatever remains is in accordance with the partnership profits. Okay? Now, just want to call to your attention that, and again, if you look at revenue ruling 95-41, this is not a hard revenue ruling to read. Well, it is. I mean, it is because it's dealing with non-recourse liabilities, which by definition are not easy to read. But I just call to your attention, it's a nice revenue ruling because it goes through the 3 tiers. It goes through the 3 tiers. Tier 1, spelled out on page 216, Tier 2, page 217, and Tier 3 on page 218. I just call to your attention on page 218, there's actually, Michael, with the, in accordance with the profits interest, you'll see there's a lot of flexibility. There's actually 4 different ways to divvy up outside basis on the basis of profitability. So there's a lot of flexibility. All right, so if you haven't already, take a look at this. Our agenda tonight is just to finish this up. We left off one problem on page 222. And then the good news, guys, I think, fingers crossed here, I think chapter 7, dealing with compensating a partner, is, I think, a lot easier for most people than some of the other material we've been looking at. So if that gives you any solace, the good news is tonight should not be as mind-wrenching as perhaps some of the other nights, but maybe it's wishful thinking on my part. Any questions on the material? Anything come to mind? Now keep in mind, guys, next week is our exam, so we're going to meet here at 6 o'clock sharp. No, people on WebEx, you can't do it on WebEx, okay? You got to be here physically, and part for the course, if you could, bring a number 2 pencil. Simple calculator can't hurt. Nothing electronic, so no cell phones, no Apple Watches, nothing electronic, okay? Any notes? Of course, the code. What would tax be without the code and regulations? Or any supplementary material you want to bring. I will be around for the entirety of the week, so if you get stuck having a sleepless night, please reach out to me. And I've said before, in the subject line, just put partnership tax student. If I do not get back to you for whatever reason, somehow it got lost in cyberspace, guys, just reach out to me again. You have my phone number, just get in touch with me, all right? Generally, I try to get back to people within 12 hours, if not sooner. Any questions logistically or otherwise? Go ahead, Renee. Just say it loudly. Excuse me? No, we gotta keep chapter 7. I gotta keep you guys going. You tried, but no, we gotta, and then the final is cumulative, so.
Well, if it's easy, we want it on the midterm.
Yeah, it should be easier.
Yeah.
Make the midterm easier. Go ahead, Ed.
Usually, if you get a sample exam, like exam,
Well, look, I said, if you could, go through the book. Someone had it last class. I brought it last class, the partnership. Go through that book, the Black Series. The exam's gonna be very similar. I will do my best. Yeah, Corey's holding it up. I will do my best to try to keep the exam as straightforward as possible. I mean, partnership by its nature is challenging. I'm on a level of, 10 being the most challenging, 1 being the most straightforward. I generally aim for 2, 3, but sometimes with partnership, just because of the nature, it becomes a 4 or 5 just because. But I'm not going to be asking you about tiered partnership arrangements and all sorts of complicated stuff. So just guys, I'm looking for you to master the basics, the fundamentals, okay? I think you can hold me to my word. You be the judge. All right, but again, I will be around. I did see a movie last night, hold on, someone told me I misspoke it. Booksmart, about two young women in high school coming of age. You know what movie I'm talking about? No.
They have a wild time.
Yes, what's the name of the movie?
Booksmart.
It is Booksmart, right?
Yeah.
They end up, they were accepted to top ranked schools, but they had no fun in high school, right, Kevin?
Yeah, so they just wanted to let loose.
Yeah, and then they found out their friends who were having fun got into very similar schools, and they thought, gee, they got deprived the whole time. So, interesting. Anyone else do anything the last week or so? Interesting? This is a class that was busy with partnership tax, which I'm proud of. Remember, October 26th, we're up to like 33, 34, 35 people now. So if you could, remember 2 out of the 3 topics, partnership tax related. So cannot hurt you.
The final?
You never know, Kevin. You never know. Okay, Renee?
I'm still going, but,
Renee, you had a question?
Yeah, in the interim closing of the books, that is, how are the segments determined? It starts on the first day of the tax year, but they count them.
Whenever the percentage ownership changes, you close it right there. Okay? That day. All right? Any other logistical questions? Kevin's coming to the event.
the exam will have similar structures to like your other exams.
The exams will be very similar, okay? True, false, multiple choice, short answer, right? Been there, done that, right, Kevin? All right. All right, so we ready to pick up where we left off? Goal line tonight. Compliments of Renee is finishing up chapter 6, and Renee finishing up to the best of her ability chapter 7. All right? All right. So, I believe we did not get to question 3, right? True. Meaning everything else we got to. All right. Question 3. The equal AB partnership only asset is building 1, which has a fair market value of 800 and an adjusted basis of 300. C wants to become a 1/3 partner by contributing building 2 with a fair market value of 700, adjusted basis of 150, which is subject to 300,000 of recourse. I have the word recourse circled, right? Because I want to make sure if I'm doing my analysis, I differentiate between recourse and non-recourse, which the partnership assumes. At the time, C's contribution, C revalues his assets under the 704 regulations. So, I have building 1, building 2, and 800, 700 fair market value. Does this deal economically make sense to the partners? The answer is yes. Why? Because A and B presumably have $400,000 worth of value, right? Because that's what the building is worth. Building 1, agreed? And building 2, when you subtract the liability, what's the net value of building 2, guys? 400. So if you were A and B, you might welcome taxpayer, right? Taxpayer C here, because as a result, everyone's got $400,000, right, at stake. So the question is, how are we going to treat the $300,000 liability? Yeah. How would you treat the $300,000 liability? When I say the word treat, what does that mean?
Allocation, yeah. 1/3 each.
Right. What is A, B, and C's capital count, guys?
400.
Everyone agree? Their capital count is 400,000, right? Everyone agree? That represents their economic stake in the enterprise. So on the day C enters, their capital account should be 400,000 apiece. Not their outside basis, their capital accounts. Hey, what's wrong?
No, nothing.
You're good? You're okay? Everyone's okay? Now, what exercise we do with recourse liabilities? Doomsday scenario, right? Everything becomes worthless. If everything becomes worthless, what kind of loss are we looking at, guys? Ramon? What kind? Say again?
1 million per
Yeah, $1.5 million loss, right? Because building 1 and building 2 become worthless, right? And how would that loss of 1.5 million be divvied up?
Equally.
Equally, right? So what are the effects of A, B, and C here, guys?
Well, this works because the liability is 300 and they would lose 300. They would owe
Who's
300.
they? Be careful of your pronouns.
Oh, the partners.
So all three?
Yeah, in the doomsday
This should bring you
scenario.
back down memory lane. We're going back to chapter 2. So everyone feeling a little nostalgic here? So,
Oh, C got the gain. Sorry.
well, you're saying it to yourself, but say it for everyone else too, B?
Minimum gain.
Don't use the word minimum gain because that connotes like a tough slide gain. Say again, Michael. Say it loudly. How much did C get a deemed distribution of? By the way, it is warm up here because of the screen. So this screen throws all the heat. So anyway, having said that, and plus the heat outside, it's just warm. Anyway, putting that issue aside. Michael, C shed liability. C shed how much liability?
300.
200. Right? Because C is going to
Oh.
still be responsible for 100 of the 300. C shed 200, right? Does C have any income as a result?
Yes.
50, right? Because he's deemed to have a distribution of 200. What's his outside basis? 150. Gain of 50. Everyone had that, right? So this would be, Renee, this would have been easy on the midterm, right? C would have had $50,000 a gain, right? Chisholm, you had that? Good to hear. Chisholm, any other effects to the A and B? Just say it loudly.
The West allocated.
I'm sorry.
The West allocated between A and B.
What does it mean? Just articulate for me as the client. What does it mean the rest allocated between A and B?
Yeah, outside is.
Say again, Chisholm. Why 50? Simi, do you agree? Isabel? Nikki? Chrissy? Guys, George,
You increase outside bid by 100 for each.
who's each?
For A and B.
A and B's outside basis would increase by 100 apiece, right? Because that's their share of the recourse liability. So let me summarize. Taxpayer C is deemed to have a distribution of 200,000. He can't have, or she can't have a negative tax basis. Everyone agree? So C's tax basis for your notes goes to 0, right? C has a $50 gain, right? And A and B, we don't know what their outside basis is, right? We're not told that in the problem, but it has to, under 752, go up by $100 a piece, right? So notice how we're using capital accounts. Okay, everyone agree? We're using capital accounts as a mechanism to figure out, help us, or as a bridge to figure out outside tax basis under 752. Notice, this is not their outside basis. It's just a mechanism utilizing an artificial mechanism, right? Fingers crossed that this partnership does not face doomsday, right? So this is completely artificial. Okay? But you go through this exercise to figure out the effects to A, B, and C. And again, summary, C shedding 200 to 300 liability, resulting in a deemed distribution. We saw this in problem in chapter 2. And then A and B, because they were assuming, just like in Crane, right, our famous Crane decision, if you acquire property using recourse or non-recourse liability, your outside basis, right, takes that into account, and your basis goes up, right? Everyone agree? That's the famous Crane decision. So everyone had this right for their notes. Elizabeth, you okay? What's the problem? You look flummoxed.
Yes.
Which part?
All of it.
Right.
So
But
can I-
you've written it down, and you can go back to it, Elizabeth? I mean, what doesn't help if you just look like a deer in headlights, and you don't understand, and you don't write it down, it doesn't give you an opportunity to go back. So Elizabeth, I want you to write it down, and then think about it, go back to chapter 2, and then if you have a problem, try to articulate it in a question to me, okay? See?
So the answer to question A, how is the 300K liability allocated, is equally? Or,
The allocation is equal to A, B, and C.
okay,
With the caveat that as a result, de facto, C has shed 200 to the 300 she contributed, right?
okay. So in the event of the doomsday scenario, we have I guess there's a different treatment?
Well, this is the doomsday scenario,
Oh,
right? This is doomsday, right here.
okay.
This captures doomsday, right there. Both
Right.
buildings became worthless.
Right, okay.
I can think of worse versions of doomsday, but for our purposes, this is
Right.
doomsday.
Right.
I think we've all seen some movies that are, a little scarier than this.
I hate those doomsday movies.
It's funny. Is anyone here into horror movies? Like really, really? I see some hands going up. And why is that, David? get some adrenaline going. All right. You were gonna say?
When I was young, I watched a horror movie night, and I was sleeping in my bed, and I saw that the ghost and I was sleeping and was crying, and I had to run to my mom and sleep beside her. So I was really scared when I was young.
There's some movies I think we can all remember when we were younger, horror movies that we will never forget.
Yeah.
The final scene in the movie Carrie stands out as a movie like I still remember and be haunted by that. So there's a few. All right. I will say, don't. One of my favorite movies, The Sixth Sense, is truly on top one of the most creative movies ever seen.
I have to say that The Exorcist can never be beat.
Okay. Exorcist, there we go. Fan. Julia, you're no fan. My wife, romantic comedies. That's, okay. Question B. We're all good with question A? And Elizabeth, if you like Elizabeth are having problems, please go back. Look at chapter 2. Look back at this. Questions, let me know. You got to know this. Question B. We're going to mix it up now. What results in A if the liability is a non-recourse debt secured by building 2, and the partners agree to use the traditional method to allocate the 704C gain? So let me put this as A. Let's talk about B. Now, how are we going to divvy up the non-recourse? Well, we're going to divvy it up in accordance to the 3 tiered layers, right? The 3 tiered layers. The minimum gain, the 704C gain, and then in accordance with profits. And that profits, right, is highly flexible. By the way, Patrick, I gotta ask, what was your favorite horror movie? You quickly raised your hand on that one. Which movie? The Grudge. Huh? You didn't like it, Kevin?
Stop.
All right, there's no fan, but difference of opinion.
Yes.
All right, just curious. All right, so in this case, remember, we got the 3-layer cake. Everyone agree? It's not, I don't want, to just leave here and remember, recourse liability is pretty straightforward. We got the doomsday scenario. Non-recourse is more challenging. Okay? And in this case, we don't, if you look back at that revenue ruling I just drew your attention to, there is no minimum gain. There is what's called the 704C gain. Why is there 70? So there's no tier 1 in this problem. There's a tier 2. The tier 2 is the liability exceeds the adjusted basis, right? Everyone agree? When C contributes his property, the liability exceeds the adjusted basis. And that being the case, C is tagged with that $150,000 of gain. Everyone agree? That cannot be allocated away from C. And what about the remaining $150,000? Okay, so on this, in question B, 150 of the 300 stays with C, which means there's no adjustment to the outside basis. Agreed? And if you look again, and for exam purposes, we keep it real simple. But again, on page 218, 219, there's 4 different ways that you could possibly split up the remaining 150. For my purposes, it's fine that C with remaining, the remaining 150, hey, they're gonna split profits 1/3, 1/3, 1/3. Okay, for exam purposes, that means that C would shed how much? C would shed 100, right? Everyone agree? C would shed 100 because C would be allocated the profits. 50, it would go 50, 50, 50. C is shedding 100, so C's outside basis would go from 150 down to 50. Everyone agree? 150 minus 100 is 50. So C's outside basis would go down to 50. C would not have to recognize a gain, unlike problem A. And A and B's, for your notes, we don't know what their original outside basis is, but for your notes, you would simply put your outside basis would each go up by 50. B, you had a question?
No, I'm just, I
Okay.
guess, once you write it down, maybe it'll become clear.
I wasn't going to write much more down, but I
Oh.
will say this, that C's outside basis goes down by 100, and their outside basis will go up by 50 apiece. Why? Because there's a tier 2, right? Tier 2, where C has a built-in contributory gain of 150. So of this $300 liability, C is not shedding 150 of that 300. C is shedding only 150, and really, because they're splitting profits equally, 50 apiece. Look back, guys, in this case in problem 2, because it deals with non-recourse liability. So look back at problem 2. And finally, question C, if C, instead of contributing building 2, contributes $400,000 in cash, and shortly thereafter, the partnership incurs a $500,000 non-recourse loan secured by building 1, how is the $500,000 liability allocated? So now each one has a capital account of $400,000, right? Everyone agree? There is no building 2. I see we have a new participant.
The youngest tax student.
We've had some babies coming. I think Angie, you brought your. Did you bring?
My daughter here yet?
Yeah.
No,
Oh,
but
you-
I will. I will one day.
One day you gotta bring your daughter here. How old's your
She's
daughter,
excellent.
Angie?
She's 9 months now.
She's getting a little old in the tooth to come. She's gotta come sooner rather than later.
She's good in income tax and corporate taxation, but
Partnership
partnership.
tax is gonna be a little bit too much for her.
Yeah, very
All right,
complex.
well, she's welcome anytime. All right, so in this case, remember, C's contributing, C's just contributing cash, and now they're gonna, partnership's gonna incur a $500,000 non-recourse liability secured by building 1. Okay? And the question is, how is that $500,000 liability going to be split between and among the partners? Right? Now, I would not, this is getting too complicated, Renee, you'll be glad, too complicated for exam purposes, okay? So, here or not. I would try to keep the exam a little bit more straightforward, but what's going on here, what the authors are alluding to, is now there's a $500,000 liability there. That's going to create a $200,000 minimum gain, right? Upside gain, because the liability exceeds the building's adjusted basis, right? Everyone agree? And remember, I'll call it, whose fault is that for creating that minimum gain?
A.
Remember, C is contributing cash, and if A and B had contributed cash at $400,000 and they bought a new building, the adjusted basis would have been, right, $800,000, and there would have been no minimum gain. Agreed? There would have been no minimum gain. So who has to be tagged with $200,000 of that 500,000 liability?
A and B.
A and B. A and B because they're the ones responsible. So of that $500,000 liability, the first 200 or 100 to A, 100 to B should be allocated to A and B. What about the remaining 300? The remaining 300 would be in accordance with the partner's profits interest, and then it would be allocated A, B, and C for my purposes. Their basis would go up 100,000 apiece. So for your notes, you will like this is, and I forget about, I'll just write it down. A and B, it go up 200,000 each, and C would go up by 100. Why? Again, because A and B led to this 200,000 minimum gain. That's why they're going to be tagged with that. But for exam purposes, fear not, that's not going to be my go-to problem here. Okay. Now, I said we're not going to worry about question 4. We don't. It's just not necessary for our purposes. Okay. That's even gets to another level of complexity, which I think you guys have enough brewing that you don't need just one more dimension. You ready to move on to chapter 7? And like I said, chapter 7 should be, fingers crossed, easier to absorb. In chapter 7, starts off with an introduction, payments for services. And talks about, if you look at page 224, there's 3 different ways partners can be compensated for the work they perform for partnerships, okay? Page 224. Part 1, transactions between a partnership and a partner not acting in his or her capacity as a partner, okay? Transactions between a partnership and a partner where you, act as a non-partner. That's a 707A1 payment. The second part of the chapter deals with so-called guaranteed payments. Payments made to a partner in his or her capacity as a partner, but he or she demands certain income no matter what the income of the partnership is, okay? So there's a demand that he or she gets paid, hence the notion of guaranteed, no matter what the income of the partnership is. And then any other payments made to partners in their capacities as such. Regular partnership allocations. It's their distributive share. All right? So, if you want to open the code, so that's in a broad brush stroke what we're going to do. But let's just open the code section to familiarize ourselves with some relevant code sections. First, 707A1. Partner not acting in capacity as partner. If a partner engages in a transaction with a partnership other than in his capacity as a member of such partnership, so if you're not acting in his capacity as a member of the partnership, the transaction shall, except as otherwise provided, be considered occurring between the partnership and one who's not a partner. And then we're going to see that if you look at code section 267, code section 267 is often, you deal with loss disallowance rules. So that if you sell securities, for example, stock, you buy Google stock for $1,000 per share, and it's now worth 800, and you sell that stock to your child, can you get that loss? And the answer is no. Code section 267 disallows the loss. Or if you take that Google stock and you sell it to a corporation in which you own more than 50%, code section 267 disallows that loss. So 267 is a big loss disallowance provision. And also in 267A2 requires matching. What that means is that with respect to partnerships, if the partnership is an accrual method partnership, which many are, it cannot take a deduction until its cash method taxpayer includes it in income. I'll repeat. Code section 267A2 isn't a loss disallowance provision. It is a provision which requires matching between partnerships and partners. Okay, requires matching, income and deduction matching between partnerships and partners. Okay, 267A2, and also if you're looking for the relationship, that's if you look at code section 267E, it talks about special rule for pass-throughs. It's essentially saying that a partnership and a partner are considered related parties for purposes of code section 267. Right? That's why the authors cite you to not only 267A2, but code section 267E. All right. And good news, when you look at this Pratt case, it helps illustrate what taxpayers, the games they used to play. And it says taxpayers here would, in the Pratt decision, the partnership was trying to accrue a deduction in year one, but the taxpayer, the partners, were cash method taxpayers that would not have to include it in income until year two. So the game being played here, as the authors of the opinion make clear, is deferral. Deferral. And the question that this case addresses back in 1975, were these partners acting in their capacity as partners? If they're acting in their capacity as partners, when must they take it into income? When the partnership year closes, right? Code section 706. So if they're acting in their capacity as partners, the partnership tax year controls. If they're acting as non-partners, right? If they're acting outside their capacity, then their own method of accounting might be able to apply. Well, who prevailed and why here? Well, if you read the last paragraph of the opinion on page 226, it makes it pretty clear. Petitioners in this case were to receive their management fees for performing services within the normal scope of their duties as general partners and pursuant to the partnership agreement. There's no indication that any one of the petitioners was engaged in a transaction with the partnership other than his capacity as a partner. So taxpayer loses here, right? They were acting in their, so 707 does not apply, 707A. Instead, we're under the general default rule. I'll call it Rule 3. That's Rule 3 found on page 224. They're just getting, they're entitled to their distributed share. Who cares? Now, why do we care about this? Well, the authors make clear. Well, first of all, in the note that follows this case on page 226, they talk about I have highlighted red under the italics partner versus non-partner status. The last sentence. Non-partner status is more likely to exist when a partner is acting as in an independent capacity, rendering services of a limited technical nature, or in connection with a specific transaction. That's when Code Section 707A is most apt to apply. What's at stake here? Why do we care? Page 226, 227 articulates the reasons. One is a question of timing. When is the taxpayer going to have to include it in income? So timing is an important and relevant issue. And the character of the income. If you're getting it in an independent capacity, you're probably going to get it as ordinary income for services rendered. If you're getting it as a distributive share, well, if the partnership has both ordinary income and capital gains, you're probably going to get a combination of ordinary income and capital gains. So this can have an effect how you classify income performed for services. How you classify it can have a timing effect as well as an effect on character. And we all know from our basic income tax course, right? Character matters. Why? Because, I'm stating the obvious, ordinary income, highest tax rate 37%, capital gains, typical tax rate is 20%, right? So there's a almost doubling of the tax rate depending on how this is characterized. So the authors discuss the timing issue, they discuss the character issues. They do a little bit, and I don't know, my own thoughts, guys, I may be short-sighted. I don't know how long Code Section 199A is going to survive. Right? It's highly problematic. I don't know. I don't want to spend too much time either in the class or on the exam. I mean, look, again, without getting into the politics of it, if Trump is reelected, it will stay. If Trump isn't reelected, I don't know if it will disappear, but there's much greater likelihood it will.
Isn't it supposed to stay till 2026?
What? It's
Isn't
supposed
it-
to lapse in 2026.
Okay, so in any case, it'll stay till 2026, right?
No, it could be repealed tomorrow. It won't be, but in 2020 it could be repealed. And everyone check their watches. The word 2020 used to sound very far off, but can I say it's in a few months? Seems weird, that's all I have to say. All right, so generally, make the observation that generally, partners cannot be employees, okay? Partners cannot, generally will not. Any of you prepare Form 1065s, which are partnership tax returns in K1s. Unless I'm missing something, you guys can, those who are preparing these, do not send W-2s to partners, right? Anyone ever send a W-2 to a partner?
Sometimes they want to have W2. I know it's wrong. Sometimes he insists.
When you say it's wrong and they insist, you send them a disclaimer, this is wrong,
I told them.
because at some point, they could sue you if you just do it, because, oh, they told me to do it. I don't know. That's asking for trouble. Why do they want it? I don't get it. Ben? Oh. Say again, Michael? So someone's got to man up and do the right thing. All right, for our class, for exam purposes, and for your client base, do not issue W-2s, okay, my opinion, okay? All right, because then, I know what you're saying, they're insisting, but then some other accountant gets a hold of it and says, what's this idiot accountant doing? So, you can't win, all right? There are some cases that suggest that maybe you could be, a partner could be an employee, but for our purposes, the IRS has always embraced the stringent rule that you cannot be an employee for partnership tax purposes, okay? All right, page 231. What type of services are within the scope of Code Section 707A1? Are they normally the type of services rendered by employees or more likely services rendered by independent contractors? So, Francis, you have any ideas there? Not sure? Shannon? Just say it loudly because the people on WebEx won't get mad at me, they may get mad at you. More like independent contractors, right? They're one-time service, specialized in nature. They're generally one, hit or miss. You bring a certain expertise to the table that's not related to the normal partnership activities. You're probably apt to receive a 707A1 payment, right? Right? The traditional example is where you have a real estate venture and one of the partners coincidentally happens to be a lawyer and you pay him or her a fee for helping close contracts, right? So yes, they're a partner, but that's not what the partnership does. They're not a legal partnership. So that partner who's performing specialized legal services would be paid X dollars to do each closing, right? Question 2. The AB partnership is a real estate development business. The partnership recently was involved in a lawsuit concerning the legal title to a parcel of land it acquired. Okay, it's a real estate development. The partnership recently was involved in a lawsuit concerning legal title to a parcel of land it acquired. The partnership paid partner B, who is a lawyer, a $5,000 fee represented in legal proceedings. How should the partnership treat the partnership and B treat the payment for tax purposes? Well, yes, I gave away my hand to some extent. How is the partnership going to treat it?
Like,
Say again, George?
Third party.
It's 707A1 payment. The partner's going to have ordinary income. Can the partnership deduct it? The fee being paid here?
yes. It should be able to.
Yes.
Ramon? To say it loudly? When the partner picks up the income, one thing you guys are forgetting. Maybe it's a Wednesday, you had a long day, hit a little traffic, right, Corey? So maybe you're forgetting that. You gotta capitalize some of this, right?
Oh,
Regulation 212-1K, right? That when you acquire title to property and you pay money to acquire title, that fee has to be capitalized in the basis of the acquired property, right? So the partnership, whatever they paid for the property, they paid $200,000 and they paid $5,000 a legal fee for clarification for title. Then the basis in the property would go up to $205. They could not immediately deduct this expense, right? Remember those? Don't forget Code Section 263. Okay, so the fact, right, guys? Remember the code is often asymmetrical. Asymmetrical meaning even though the partner has to pick up immediate income, doesn't mean the partnership gets an immediate deduction, right? Everyone agree? We're all good with that? Like, do not get fooled. Renee, I'm not trying to trick you on an exam, but I would not want anyone to leave this room under a misimpression that any expense that you incur in the context of a partnership somehow could be automatically deductible because the partner has income, right? That you cannot forget the capitalization rules, right? Would you consider that a trick question if I asked? I hope not. Right?
Now that you said it, no.
Now that I said it, okay? But you'd be surprised, Kevin. I said it, but some people in this room will miss it nevertheless. And I don't know why, because I want people to do well, and I want them to succeed, but everyone listening, make sure you got that. Go ahead, George.
Just have a question. This is not he didn't pay the 5,000 to buy the land. It is do suit against the, it's just
Yeah, but anytime you have to pay money to keep clear title, you gotta capitalize it. And I'm 99% sure, I hope I'm giving you the right site, doing that by memory. Again, regulation 212-1K, let me just see if I nailed it, and I apologize. I'm not in the business of trying to mislead you, but I think that's. Look! Expenses paid or incurred in defending or perfecting title of property and recovery, da-da-da. These are all expenses that you have to capitalize. So, there you have it.
What's it called, 263 what?
No, well, 263 is that's capitalized capital expenditures. Regulation 212-1K talks about perfecting title, and you have to capitalize those expenses.
Would that have to be an entirety or just?
No, you have to capitalize that entire expense. All right, let's not dwell on this. I mean, this is a fundamental precept of tax, right? This is not unique to partnership tax. Everyone agree? This is not something you find in subchapter K. You find it generally under 263, which is universal. Agreed? So this is one of those code sections or reminders, guys. Anytime you have an expense, you've got to dwell and weigh, should it be expense immediately or should it be capitalized, right? This is, again, not unique to partnership tax. Disguised payments. Are taxpayers cagey? Yes, that was a rhetorical question, but yes, right? And therefore the code tries to protect the base. And if you want to look at code section 707A2A. 707A2A. Says, under regulation prescribed by the Secretary, and if you look at A2A, if, so we have a laconic if, the following three conditions, they're conjunctive. You've got to meet all three conditions, right? A partner performs services for a partnership or transfers property to a partnership, and there's a related direct or indirect allocation and distribution to such partner, and the performance of such services and the allocation and distribution, when viewed together, are properly characterized as a transaction occurring between a partnership and a partner, okay? Acting other than in his capacity as a member of the partnership, such allocation and distribution shall be treated as a transaction described in paragraph 1, as if the person were not a partner. So what's going on here, guys? Is that often a partner may perform services, and the partnership, in some form or respect, wants to circumvent the capitalization rules that we were just discussing. I'll repeat that these disguised payments are often a mechanism to try to avoid the capitalization rules and achieve a de facto immediate deduction. And what this is saying is you can't do that. Okay? That if you try to circumvent, in particular, the rules under Code Section 263, we're not going to allow that to happen. Now, what the authors do, and I'm not faulting them because, but for the grace of God, go I. They rely primarily on legislative history, okay? They look at the congressional report and they say, and they say, when does code section 707A2A apply? What are the conditions? How do you identify conditions that will result in the application of this code section? And they name 5 factors that will play a role in identifying when this code section applies. And these 5 factors are enumerated beginning on page 233. 5 factors. Beginning on page 233. Factor 1, at the bottom of page 233. The first and generally most important, so these factors are not all equal. To the contrary, the first factor is the most important one. Is whether the payment is subject to appreciable risk. If there's little risk, that likely designates that the person is not performing as a partner. Let me repeat that. If there's little risk, the person is apt to be, this is apt to be a 707A payment as to a non-partner. Why? Because non-partners, when Solid performs work for a partnership, or you perform work, right, as their accountant, do you want to get paid no matter what? You don't want risk, right? Because you know if the partnership makes money, you're not sharing in their profits. And if the partnership doesn't make money, you still want to get paid. Everyone agree? So you guys function as a non-partner independent, right? As a non-partner, you don't want risk, right? So the less risk there is, the more likely it is that it's a non-partner. If there's lots of risk, who takes risk? Partners in the enterprise, right? So this is the #1 criteria. If there's a lot of risk, you're probably functioning as a partner. If it's set up where there's very little risk, you're probably not a partner. Transitory, page 234. If you're a partner for a short period of time, probably means you're not a real partner. Partners are in it for the long haul, right? Partners generally don't come in and out of partnerships. So if you're only going to be a partner for a short period of time, get your money for your services and get the heck out, that probably means you're not a true partner. You're probably acting in a non-partner capacity. Timing, third factor. Generally, partners don't mind keeping working capital in the partnership, right? They're in it for the long haul. Keep the money in. But if non-partners like yourself, you want the money ASAP, right? So if someone performs services and they're quickly as a distribution to that person, probably code section 707A2A applies, right? If there's a quick turnaround. Factor 4. Why is the person a partner? And did they become a partner simply to help achieve the tax effects, the sought after tax effects? Is there a real reason this person became a partner? And finally, and this is relating to the transitory nature, the fifth factor is whether the person has a continuing interest in the enterprise. Do they have a continuing interest in the enterprise? All right. So these are all factors to consider. Why is this relevant? Because in the absence of this code section, people could become partners simply to help achieve various tax-favored effects. So this is a safeguard from that happening. Let's look at the problems on page 237 to make sure we're all on the same page. A, the cash method taxpayer is an equal partner in ABC partnership. An accrual method taxpayer has a $10,000 outside basis in our partnership interest. A provides regular ongoing services that are not, I circled the word not, and they're not related to the primary business activities of the partnership. Before any of the transactions described below, the partnership has $10,000 in net ordinary income for business operations each year. What results under the following alternatives? The partnership will pay A $2,000 per year for 3 years for his services. Okay? Yeah. What's gonna happen here, guys? Say again? You would have to check the 5 factors, but they make it clear, right, that he's not functioning in his partnership capacity. So it looks pretty clear, right, that this is just a plain vanilla 707A1 payment, right? He does have a gift, but it's clear that it's not related to the primary business activities of the partnership, right? And he's demanding, what does it say? He will pay $2,000 per year for these services, but it seems to me like it's just a payment for in a non-partnership capacity, right?
So is it still deductible by the partnership as a regular expense?
Well, it should be, but let me just, Sandra, you had a question or statement?
Well, I guess for A, because he's cash method, each year he gets the cash reported out of their income.
Well, we're not, first of all, he's a cash method taxpayer, right? So when is he gonna get the actual physical payment, guys?
2,000 per year for the next 3 years.
Okay, so let's just make some observation. Can the partnership deduct these $2,000 payments? They can deduct it, the partnership, not they. The partnership can deduct it, and B, I don't know if this is gonna get your point. It can deduct it as long as partner A includes it in the same tax year. What's my authority? Code section 267A and 267E. So the partnership can deduct $2,000 a year as a 707A payment, which leaves how much net income, guys? Each year?
8,000.
8,000. And how much does that mean is taxable to all the partners of that 8,000?
2,000 each.
2,000 each. So A has to include 2,000 ordinary income. The other partners, including A, also have $2,000, right? That's 1/4 of the $8,000 that remains each year. So that's the answer to A. The authors just want to give you a simple illustration of a 707A1 payment, right? Question B. What results in A above if the compensation payments are made on January 31st of the year following accrual? What would happen in that instance, guys? What code section comes into play? The partnership cannot deduct it until year 2, right? Why? Because code section 267, right, prohibits deduction until the 2nd year because there has to be a matching. Here there must be matching. Why 267A2? 267E. There must be matching. How would your answer to A change if the partnership generated no income from business operations for the year, but instead generated $10,000 of long-term capital gains?
The partner would still get ordinary.
Okay, who said that? Sandra? Partner would have 2,000 of ordinary income. What affects the partnership?
It would be split 8,000 remaining by.
Oh, no. You have 10,000 in capital gain and 2,000 ordinary loss, right?
Yeah.
So what ends up happening? Each partner, A, B, C, and D, each would have a $500 loss, right? And they'd have 2,500 in capital gain, right? Everyone have that in their notes? Because, again, this expense would generate an ordinary loss, and under 702 principles, you would, on the K1, right? Blue swap, right? On the K1, you would have to show each one having a 500 loss, ordinary, and then 2,500 of capital gain. You wouldn't amalgamate these. We're good? See, I told you this was a lot easier than dealing with recourse and non-recourse liabilities, right, guys?
Can the midterm be all on chapter 7?
Renee wouldn't let me.
She would.
Question 2. Consider the following example adopted from the legislative history. Commercial office building constructed by a partnership is projected to generate gross income of at least $100,000 per year indefinitely. Nice. Architect, whose normal fee for the architectural services is $40,000, contributes cash for a 25% interest in the partnership and receives both a 25% distributed share of net income for the life of the partnership and an allocation of $20,000 of partnership gross income for the first 2 years of operations after the property is leased. The partnership expects to have sufficient cash available to distribute $20,000 to the architect in each of the first 2 years, and the agreement requires such a distribution. And what factors are the most important in determining whether the $20,000 allocation of gross income is a share of profit or a 707A2A payment? Should we treat this payment as a fee to the architect, or should we treat it as a distributed share? Fee
Well,
or distributed share?
It's a distributive share because it comes from the income. What if the partnership has no gross income? I mean, of course, we are told that they do have a gross income for the life of the partnership, but it
You're
doesn't
troubled
sound
because this could be risky, right?
right.
Anyone have a different opinion? Anyone say it's a fee? And if you say it's a fee, can you justify your answer? You say it's a fee, Ken. Why?
Risk, since there's sufficient income and profit, and the risk is minimum, and the timing just paid the first 2 years.
All right, so Ken says, look, Michael, you're gonna say? Just say it loudly. How can it be both? We're talking about the 40,000 total, 20,000 each year. But hold on, so that's what we care about. Everything else would be a distributive share. Is that 40,000, should it under 707A2 as a fee? And V, I understand your point. This is not going to be black and white. It's not binary. But I think the better answer is Ken and Michael is that in this case, hey, you perform a service and you're getting a quick distribution, right? Nothing's guaranteed in life, right? Even you, as an accountant, you perform services. No one says you're definitely going to get paid, right? So, yes, admittedly, this architect might not get paid, but it looks like it's on pretty solid ground. He's going to, or she's gonna get paid within 2 years, and it's the money that comes off the top before anyone else apparently gets paid. The architect has to get the $20,000 each year. It seems like a priority payment, right? So that to me is pretty damning. So in this particular case, I think this is probably going to be considered a disguised 707A1. And as such, what this means is, just think about it, this expense should probably be capitalized, right? Because it's an architect who's helping construct a long-term building, right? So this expense probably should not be deductible by the partnership. Right, Code Section 263, which is what we just went through. All right. All right, so just wanted to make sure that if anyone had any questions here. All right, so we got these. Does this come up all the time, guys? The answer is no, it doesn't come up all the time, but that's what makes it dangerous. It doesn't come up all the time, and therefore, you gotta be, if someone comes up with these kind of arrangements to say, gee, we got a real nice thing going here, you gotta be the one to say no. There is a code section that, so if anything sounds too good possibly to be true, I know we're creative in this room and you may be the first one to have come up with it or your client, but believe it or not, the code now has 100+ years of history. There may be some people, one or two, just as smart as yourself or your clients. So make sure you really scour the code if you think that there's this great method to minimize the tax burden and you know your client's sure no one has ever thought of it before. Just be forewarned. There's a lot of bright people who walk the planet. All right? All right, we're ready to talk about guaranteed payments for a few minutes and then we'll take a break. All right, let's talk about guaranteed payments. And what are guaranteed payments? Well, the name, the moniker speaks volumes, right? Code Section 704C. I'm saying 704C, I meant 707C. 707C, guaranteed payments to the extent determined without regard to the income of the partnership. So it doesn't matter what the partnership earns, this person wants to get paid X dollars. Payments for the partner for services or the use of capital shall be considered as made to one who is not a member of the partnership, but only for purposes of Section 61 and purposes of Code Section 263, that's the capitalization rules, for purposes of Section 162, subject to 263, and for purposes of 162, ordinary and necessary business expenses. And the regulations the authors direct you to, if you take a look, 707-1C. Okay. The regulations elaborate a bit about guaranteed payments, and they offer 4 examples, which we're going to see towards the end of this material are a little out of date, that those examples have been revisited. But for our purposes, on page 238, I'll just call to your attention at 238, the second full paragraph, towards the middle of the second full paragraph. The 2 things that I have highlighted, when I say highlighted, the 2 most important things about guaranteed payment. Beginning in the second paragraph in the middle, it says, as such, They are taxable to the partner as ordinary income, regardless of the amount or character of the partnership's taxable income, and they are deductible by the partnership under 162, subject to the capitalization rule. So that's one pivotal rule, okay? That's part one of guaranteed payments. They're always ordinary income. And the second part is the remainder or balance of that paragraph. For timing purposes, however, guaranteed payments resemble distributed shares in that they are included in the income for a partner's taxable year within or with which ends the partnership taxable year in which the partnership deducted such payments as paid or accrued under its method of accounting. So they must be included in income whether or not they are received. So guaranteed payments have a foot in both worlds. On one hand, they look like a 707A1 payment. On the other hand, they look like a distributive share, okay? So everyone notice that they have a foot in both worlds. The next paragraph talks about what does, when you have a guaranteed payment, what happens to your basis in your partnership? Do you have a basis, tax basis in the guaranteed payment, or does the guaranteed payment cause your outside basis to go up? I'll repeat. The authors raised this question, and it's addressed somewhat in the Gaines case. Does your basis increase do you have a basis in this intangible asset known as your guaranteed payment? So that's one option. Or secondly, does your outside basis increase in your partnership asset, in your partnership interest? And just know in advance, I think you guys are getting a sense of this. Some of the challenging issues in partnership tax are not even in the year 2019 resolved, okay? So it's not that I'm trying to hold back on you and say, I'll keep this close to my chest and I will not reveal, there's some secrets that are meant to be secret. No, I in full disclosure, that there are some things that are truly in partnership tax, in particular in this chapter, unresolved issues. So just know that. I'm not trying to be cryptic. And that issue that we just raised is not truly addressed, right? Has not been fully resolved. So let's talk about the Gaines case for a moment. Anyone want to talk about what happened here? Here, just so you know, the payments being made to one of the partners, the partner in question, was a guaranteed payment, okay? This case illustrates that a payment being made here, notwithstanding the partnership's income, this partner was going to be paid X dollars. So it's clearly a guaranteed payment. But it was not going to be fully deductible by the partnership. Why was it not going to be fully deductible? Because Code Section 263 applied. It required it to be capitalized. And the recipient partner who is entitled to the guaranteed payment, or let me rephrase that, the partnership said, look, how do I say this? That the partner said that the recipient partner said they should only be taxed up to the amount that the partnership could deduct. In other words, the partner and partnership were looking for this symmetrical outcome, that whatever was going to be able to be deducted, that's what the partner was willing to include in income. And the court said, no. With a guaranteed payment, you must have included in income. It doesn't matter what the partnership can deduct. The fact is, there's an asymmetrical outcome, does not matter, all right? And that shouldn't strike anyone in this room as surprising. So the takeaway of the Gaines case, it simply illustrates a few basic principles. It just demonstrates what is a guaranteed payment. 2, it demonstrates that all guaranteed payments are not fully deductible, code section 263. And if you look at the footnote 16 on the next page, this is on page 242. The footnote, as part of the partner's distributive share of profit and loss, the guaranteed payments included in his gross income increase the partner's, and you may want to put in outside basis in his partnership interest. And I thought this was something that you should be able to take away. If you look on page 242. It specifically says on the top on page 242, it says in Kangle, however you pronounce that case, we held that includability and deductibility of guaranteed payments are two separate questions, right? There are two separate questions. And specifically that guaranteed payments are not automatically deductible, simply by the reason of their being included in the recipient's income, right? So again, my emphasis that there is no symmetry here. Now, we have a revenue ruling, then we'll take a break. 69-180, which, if you check your calendars, is reached the 50-year mark, right? Half a century. And it's not that hard to follow, and I encourage you, like I have in the margins of my book, just to write some numbers on the outside. What the guaranteed payment is, what's the ordinary income, what's the capital gain, and just continue on the margins. Do not read these things passively. You've got to write out numbers, right, guys? If you read it passively, I don't think you can absorb it. But it talks about how to ascertain, and we're going to go through an example that illustrates the mechanism of how this revenue ruling works, so fear not. But I do call your attention on page 245, where the authors go through example 2 on page 245. And the new regulations greatly simplify what is a guaranteed payment. They take away some of the mystique, and the good news is they make it much easier, the new regulations, in ascertaining what is in this example 2. If you compare it to example 2 in your regulations, remember there's 4 examples the authors that the regulations have regarding guaranteed payments. If you look at this example 2, it's much easier. Let's just take a look one second. Partner C in CD partnership is to receive 30% of partnership income, but not less than $10,000. The income of the partnership is $60,000, and C therefore is entitled to 30%. So $10,000 is a guaranteed payment, and that guaranteed payment reduces the net income to $50,000, in which he receives $8,000 as a distributive share. Okay, that makes sense because he's entitled to total of. So the guaranteed payment is definitely going to be $10,000, whatever it's stated the guaranteed payment is. Under yesteryear rules, he wouldn't be entitled to guaranteed payment because he was entitled to 30% of $60,000, which he was already entitled to $18,000. So under the yesterday rules, there's no guaranteed payment because he got what he was already entitled to receive. But now regulations say whatever is what he's entitled to automatically will become the guaranteed payment. If you look at the next, well, look, what we'll do is when we get back, why don't we do this? We'll come back and we'll do the problems beginning on page 247, and they will help illustrate the point. So guys, we'll take our 9-minute break here, and we'll come back and we'll pick up where we left off, okay?